Today, we're going to talk about PMI. So, if you're not familiar with PMI, that's private mortgage insurance. This is a class that was created by our branch manager, Sean Hadley, in connection with or alongside National Mortgage Insurance. They're a mortgage insurance company. I'll get into some more details on what mortgage insurance is, why it's important, and why you should have a PMA about it. It's Sean's joke, a positive mental attitude about private mortgage insurance. So it's not always the worst, as some people think it's just an extra charge unnecessarily tacked on. This class kind of goes into what it is, why it's there, why it's necessary, and how, contrary to popular belief, it's actually good that it exists, because without it, there'd be far less home sales and a lot less home ownership across the market. So let's get started. How it works. So private mortgage insurance provides mortgage payment default protection for the lender on individual loans. Think of it much like a homeowner's insurance policy. A homeowner's insurance policy will protect the homeowner and the lender in the event of a loss. If there was a fire or something like that, there's enough money there in the insurance policy to pay the loan off, and in many cases cover the buyer's portion of equity, as well as any anticipated expected equity that was built from when they opened the policy, and all their personal belongings and everything, because if you have a fire and lose everything, you're going to have to recoup. So something similar to that is this insurance policy on the mortgage specifically, that protects the lender in the event of a buyer default, meaning the buyer forecloses on the home, stops making their payments, the bank has to recollect. And in many cases with a foreclosure, the bank is going to wind up taking a loss to recoup some of the money they made back. Because of that, the normal down payment requirement that's been around for many, many years was always 20 to 25%, meaning before the introduction of mortgage insurance, you couldn't get a home loan unless you had 20 to 25% down. In an effort to make home ownership more accessible, mortgage insurance was introduced at first by FHA, but eventually on the conventional loan side as well, which basically, hi Kim, how are you? I'll put this up on the big screen. Maybe. Kim just walked in. Maybe? How do I get it over there? Come on. Sorry, bear with me. There it is. All right. You didn't miss much. We're just talking about what mortgage insurance is. So, quick recap: insurance policy to cover the lender's interest in the loan when someone's putting less than 20% down. Up until like the 20s or 30s, there was no such thing as mortgage insurance. You just had to put 20 to 25% down to even get a loan. So home ownership was few and far between. It was really only, the wealthiest people that owned the homes, and they owned all the homes, and then the vast majority of people rented. An explosion of home ownership through the 40s, 50s, and 60s is what led to, really a balance of wealth amongst a lot of people as the country grew. And you'll hear a lot of people say that the home ownership is a direct line to how that wealth was built. I mean, I'm sure all of us on Zoom and in this room are telling people how much wealth they can build by buying real estate. Mortgage insurance gives the lower income, or not necessarily lower income, but the people that have less assets access to a home now. And as we all know, buying a home sooner is always better, because you're going to, one, not have to pay as much because properties go up over time, and two, you get to take advantage of the equity that your home builds as purchase prices build over time. So how it works, a little breakdown there. If you have a home value of 100,000, loan balance in this scenario, you're putting the minimum down of 95% for a conventional loan. The required coverage is 30%, meaning that the mortgage insurance policy is a $28,500 policy to cover a portion of a potential default. So the lender's exposure is reduced in this scenario down to 66,500. So you can see there that the lender's exposure is now way lower than the 80%. So it's actually beneficial to lenders whenever you introduce, and by lenders, I don't mean necessarily us who are originating loans. I mean the big federal banks, Fannie Mae and Freddie Mac, who are buying these loans. They set up all these rules and everything. It's more advantageous to them to have someone put 5% down with 30% coverage rather than put 20% down. I could get into the weeds on that, but there's actually within the loan level pricing adjustments, meaning the interest rate you get depending on your down payment. With the most recent changes, which were about a year ago, your interest rate is actually slightly better when you put 5% down versus 20% down, if you can believe that. Yeah, it's because of this calculation, because their exposure, their risk is less when you introduce the MI. The good news is mortgage insurance is available more or less on the open market. We have 6 or 7 different mortgage insurance companies that we work with. They're the biggest ones in the country. And I have a software where basically any scenario, I can pull up every single one, a quote for their current rate, depending on the buyer's qualifications. And I can just, with a click of a couple of buttons, I can give them the best rate that is available in the country on their mortgage insurance. And the fact that there are several of them and they all compete with each other, free market capitalism, they kind of beat up on each other and it keeps the rates real low because everyone's trying to undercut each other for the business. All right, I'm going to skip to the next slide. Everyone ready? All right, so some big things, because everyone thinks mortgage insurance must be an insurance policy. That's a buyer's insurance policy, right? Because they're paying for it. Not necessarily. Mortgage insurance is not life insurance. If someone passes away, it does not pay off the mortgage. It's not disability insurance. It's not job loss insurance. It's not hazard insurance. Hazard insurance is another name for homeowners insurance. So you have to still have your own homeowners insurance policy. This mortgage insurance policy is just the key to get into home ownership if you have less than 20% down. And it does not protect you in the event of fraud. A lot of people think that, oh, okay, so this policy, I'll just cash in on this if anything ever happens, my credit gets, stolen or something like that. Nope, you'd have to get your own personal coverages for things like that. There are extra insurance benefits from your mortgage insurance company. One of the ones we work with the most is called Enact. They have a whole bunch of different insurance add-ons whenever you use them. I like to default to them because of all these extra add-ons. Sometimes if they're a little pricier than the other companies, I'll shy away from them. But there are a bunch of different benefits. I know with Enact, I think they have I think it's an appliance insurance policy. Like basically they take out an extra little insurance policy for you at no cost for your appliances in the first year or something like that. It's very interesting. And they reach out to the buyer afterwards. We get like a once a year kind of report on who ended up signing up for those types of things, but there are extra benefits. Why is it critical? So I won't get too much into the weeds on this, but like I said earlier, it promotes home ownership for first-time home buyers and those with the smaller down payments. 1 in every 2.5 conventional loans mortgages are first-time home buyers. That's actually up. So this class is a couple years old. It's now 1 in 2 are first-time home buyers. Provides a credit enhancement needed for lower down payment buyers, more or less that key to even get them in the door. And it reduces the time it takes to save up a down payment. So as a good example, if we go, back about 10 years, a little more than 10 years. After the crash, a lot of these companies that existed ended up going out of business, right alongside a lot of mortgage companies. And what ended up happening is there was no mortgage insurance available. There was a period of time there. It wasn't super long, but there was a period of time there where the mortgage industry was so shell-shocked from everything that happened from 2008 to 2010 that if you had less than 20% down, your only option was FHA. There was no 3% down first-time homebuyer program. There was no 5% down conventional program. It was either a 3.5% down FHA and, you know, all of the baggage that comes with that, or you had 20% down. So if someone wanted to go conventional, they weren't interested in going FHA, really the only option was to save up. And as you can imagine, it wasn't as crazy. Inflation has made the market tough these days, not quite the issue 10 years ago. But as you can imagine, telling someone who has 5% down that they've got to save up, 4 times that to have a down payment is pretty crazy. So it does open the door. Here's a little history on private mortgage insurance. You can see, yeah, technically that they were the first MI company. It really gained growth there with FHA in the 30s, and then the creation of Fannie Mae, as you can see there, coming up on a 100-year birthday for both of them. I won't get into too much of this, but it does have a history of existing. So I think a lot of people, without knowing the history of mortgage insurance or the benefits really of it even existing, a lot of people default to, oh, it must be something that was introduced in the last 10 years and it's really just a cash grab. But it's been around for a long time, and it really was just created to try and help offset the risk or exposure that lenders take when people put less down. So let's calculate an MI payment, just because I think a lot of people think we come up with it arbitrarily. But in this example, $150,000 loan amount, 5% down. We find the MI rate, looking at the LTV, their FICO, and a required percentage of coverage. Now, the rate itself does change depending on the MI company that you use. Like I said, they compete with each other. So the rate that they charge for the amount of coverage that's required by the conventional banks, Fannie Mae and Freddie Mac, that actually changes a bit. And believe it or not, it's like homeowners insurance. They'll look at everything. I mean, even car insurance is kind of like this. If there's multiple buyers, they look at the zip code. I mean, they're looking at a lot of different statistics to come up with that rate. Once you have that rate, you multiply the total loan amount by the rate, divide by 12, and that is your monthly premium. And keep in mind that $51.25 in this scenario just gets added into the loan or the monthly payment. So they just have to make one mortgage payment. This isn't a separate thing. Single premium. So a lot of people don't realize that there is an option to just pay a one-time fee and have the mortgage insurance go away. So in this scenario, same exact setup, $150,000 loan amount, 5% down. The single rate is higher because you're paying one time to have it, basically eliminated. So the rate on that is 1.7. Take the loan amount of 150 times 1.7, that's $2,550. So in this scenario, they pay $2,550 at closing, and they'd save $51.25 per month. So, I mean, back in the day, before it was a crazy seller's market, you might be able to say, okay, well, the seller's given us some seller credit. What if we take that and we eliminate the PMI rather than buy your rate down? It might do more for them. I've had scenarios where someone is saying, okay, I want to put 5% down, but they qualify for a first-time homebuyer program that allows them to put 3% down. Well, what if we did 3% down, and then we took that extra 2% that you knew you were going to use, and we pay off the PMI, and now we eliminate PMI for the life of the loan. So I mean, people love that calculation just because it saves them money. And like I said, I know people don't like PMI, so when you tell them you can get rid of it up front, they're happy to hear it.
What if you're not gonna live in that house? What if it's just your first home, you don't plan on living there longer than 10 years? Why pay off PMI?
Yeah, there's a break even on that. So, yeah, yeah. So, think about it. $2,550 divided by 615. That's how many years you'll have to live there to break even on that. So if you're going to be there for, just doing some quick math here, if you're going to be if you're there less than 3 or 4 years, it's probably worth it to not do that. But yeah, the average is usually 7 years, 7 to 10. So there's buyer paid MI and lender paid MI. Buyer paid, obviously the premiums are paid by the buyer. It's disclosed to the buyer. The rates and regulations are based on the property state, subject to Homeowners Protection Act, refunds, meaning they're protected, they can't be overcharged, and premiums can be financed into the loan amount, subject to the CLTV. We don't really see that all that often. It's just part of their monthly payment. Lender paid MI is a little bit different, and you don't see lender paid MI all that much. We have one program where we use it, and it is our 15% down, no mortgage insurance program. The reality of the program is you're putting 15% down. There's still a mortgage insurance policy, but rather than the buyer pay it, we're going to pay it for them. And when you put 15% down, the coverage required is so small because you're so close to the 20% already. It's small enough that my company is willing to take that and just pay it. So in that scenario, I don't even see what the rates are on those. They have negotiated them behind the scenes. All the buyer is seeing is I have 15% down and I'm getting no mortgage insurance. I sell that program like crazy because people love it. In reality, I don't know what the rates are, but I'm going to guess it's, somewhere between $500 and $1,000 on a $150,000 loan that we are paying out of pocket behind the scenes to eliminate that policy. And frankly, we do it so we can stay competitive and, win a few extra deals. So you can cancel MI. I think a lot of people know that once you get to that 20% or 78% number, the mortgage insurance goes away on its own. But a lot of people don't realize, compared to FHA, depending on your initial down payment with your FHA loan when it opened, you may not ever lose that MI. The only way out of it would be to refinance with FHA. So this chart here kind of breaks it down. And it's giving a rough estimate on the time period it would take you to get to the point where the MI would go away. Technically speaking, when you reach 80% loan to value, even current value, and I'll get into that in the next slide, your mortgage insurance can be requested to go away. They would require you to get an appraisal to show what the current property value is, but it can go away. If you didn't request it goes away at 80% loan to value, it will come off automatically once you reach 78%. You can see with less than 10% down, on a conventional loan, it's going to take 7 to 10 years for that to go away on its own. With FHA, it never goes away, not unless you refinance. With more than 10% down, or 10% or more down, I should say, it'll go away on the conventional side in about 5 to 7 years. With FHA, it takes 11 years before it'll go away. This is also one of the big reasons a lot of people like to shy away from FHA if they can, especially with how quickly properties have been appreciating over the last few years. If you put 15% down, Heck, I mean, it might only take 2 or 3 years before you've got enough equity build up that you can eliminate the MI. So the Homeowners Protection Act, HOPA, as we refer to it, established rules for both automatic termination and buyer cancellation of borrower paid private mortgage insurance. So this kind of breaks that down. The cancellation, it can be requested at 80%. Automatic is at 78. On this next slide, this is the breakdown on when you can request it be removed with an appraisal. Fannie Mae rules are a little bit different. If it's been more than 5 years, all you need is 80% loan to value in that appraisal, and you can request it. 2 to 5 years, it's 75%. Used to be, I think it used to be that you couldn't do it within 2 years, but I think they waived that. And then Freddie Mac, it's 80%. If 5 years or more, 75% if less. So you're kind of in that window. I'd say for most people, if you're putting 3 to 5% down, it's probably going to take you 5 years before you reach that point anyway. And then it's a little bit different for 2 to 4 families. To be honest with you, though, I don't even technically on a 2-family home that this is primary residence. On a single family investment property, you could put 15% down. The rates are so gross, I don't even throw it out there because people will think I'm crazy. On a 2 to 4 family principal residence, it goes away at 70, or it can be requested at 70. These are all the things, I mentioned a few of them earlier, that play into the factor whenever they're coming up with MI rates. You can see down payment, credit score, number of borrowers, occupancy type, property type, zip code, self-employed. Self-employed is funny. Because in my head, I'm thinking, why do they care? But I guess, the potential for your income varying might play into the likelihood that you foreclose on your loan. Multiple people means it's more likely that one of them will be able to make the payment if the other one lost their job. Yep. Low to moderate income designation and previous bankruptcy or foreclosure. Believe it or not, there is a program within Fannie Mae and Freddie Mac called Home Possible, Home Ready. If you're under a certain income limit, you qualify for this program as a first-time home buyer. And actually, I think they removed the fact that you have to be a first-time home buyer. I think you can be a repeat buyer, just have to be under the income limit. They give you an additional benefit on your mortgage insurance, so the coverage amount is reduced. Seems like it would go the other way. If you made less money, they'd be more worried about it, but it's kind of like it's like a home buyer program, like a grant program, but the incentive is you get a lower rate. Previous bankruptcy or foreclosure, that one's pretty obvious. If someone has, negative history on their credit report, it's probably going to deter them away from a nice rate. All right. I think that's it. I know this is a pretty quick class. Any questions or anything? Lauren, any questions? My takeaway is if someone's really upset about mortgage insurance, let's say you're talking to them and they are saying, yeah, we want to buy a house, but we don't have the 20% down. Yeah. Well, we can do 3%, or I have a lender that can do 3%, lender that can do 5% down. Would you consider those? Sure, but I've heard about mortgage insurance and I think that's pretty expensive and I don't want to pay for it. Well, you might be surprised. I mean, these days I've seen insurance policies for well-qualified people with good credit. I mean, you're talking 30 to $50 a month. It's really not bad. Years ago, when these companies kind of came back into the market, yeah, it was kind of pricey because they were really worried about getting overexposed. Now, we've been through a heck of a housing boom, and now people are more willing, or these companies are more willing to compete with each other, and the rates are pretty advantageous. So cool. Well, I appreciate it. If you have any questions, let me know, and thanks for stopping by. Think so.